Okay, let's dive into this explainer. If you ever catch yourself thinking legacy banks are just these slow-moving dinosaurs, well, BNY incredibly dense Q2 2026 earnings report is about to prove you completely wrong. If you've been following the financial sector, you already know these institutions are constantly battling to prove they can innovate and grow at scale. Well, this latest update is practically a masterclass in how to do exactly that. Here is our roadmap for today. 1. Record Q2 headline numbers. 2. Strategic drivers and AI. 3. Breaking down business segments. 4. Capital, liquidity, and returns. And 5. Updated 2026 financial outlook.
Section 1. Record Q2 headline numbers.
To really grasp the sheer scale of this quarter, we've got to look at these staggering growth metrics. These aren't just incremental bumps, they are structural leaps. Right out of the gate, earnings per share absolutely skyrocketed by 27% year over year to $2.45. That single figure, it sets an incredibly powerful tone for the entire report. Seriously, when a financial institution of this massive size posts nearly 30% EPS growth, it absolutely demands your attention. And that earnings beat was fueled by a record-breaking revenue of $5.7 billion. That is a 13% jump from the previous year. It's crystal clear evidence that their core fee engines and net interest income are just firing on all cylinders simultaneously. But it's not just raw revenue. Their profitability took a huge leap, posting a 31.3% ROTCE, which is up 3.5 percentage points year over year. For a firm like BNY, breaking past that 30% threshold is a monumental achievement in efficiency. It's a real game changer. Just as a quick refresher for those keeping track at home, ROTCE, Return on Tangible Common Equity, is basically the ultimate lens BNY uses to measure its success. It strips away the intangible assets to show exactly how efficiently the bank is converting its revenue into actual tangible investor value. And at 31.3%, yeah, they are doing it exceptionally well. Section 2, Strategic Drivers and AI.
So how exactly did they pull these numbers off? Well, it definitely doesn't happen by accident, and it for sure doesn't happen in silos. It all comes down to a unified strategy anchored by what they call the One BNY approach. They've aggressively shifted focus to operating as one unified company, cross-selling larger, much more comprehensive solutions to their clients. The result? 14 consecutive quarters of year-over-year sales growth.
Now, what's truly fascinating here is how AI is moving from just being a corporate buzzword to a tangible asset across their whole client lifecycle. They aren't just talking about AI, they have actually built the strong foundation in people and infrastructure for it. They're applying these AI solutions directly into their workflows to accelerate innovating, prospecting, onboarding, and transacting. It is built right in. This disciplined strategy and tech integration has unlocked some incredible scale. Look at this, 10 consecutive quarters of positive operating leverage. Even while making $500 million in incremental investments, they are still tracking toward a massive $450 million in efficiency savings for 2026. Moving on to Section 3, Breaking Down Business Segments. Let's see how this all builds across BNY's massive global platform. Looking at their primary revenue engines, it's just a sea of green. We've got double-digit growth in both security services at 15% and market and wealth services at 12%. Even investment and wealth management is pulling its weight with a very solid 8% growth. Drilling down into the powerhouse security services segment, which brought in $2.8 billion alone, we see two distinct drivers. Asset servicing grew a really healthy 12%. But issuer services? That segment completely stole the show with a massive 23% year-over-year revenue leap, directly reflecting higher corporate trust fees. Over on the market and wealth services side, we see a highly diversified fee structure, driving nearly $2 billion in revenue, with wealth solutions leading the pack, followed by clearance and collateral management, and payments and trade. This kind of diversity creates an incredibly resilient, shock-proof revenue stream. We are also seeing a massive upward trajectory in their net interest income. It jumped 20% year over year to over $1.4 billion. This was largely driven by reinvesting investment securities at higher yields and overall balance sheet growth. It perfectly complements their fee-based revenue. Okay, Section 4, Capital, Liquidity, and Returns. Generating record revenue is great and all, but efficiently managing it is where the rubber meets the road.
BNY maintains an absolute financial fortress of a balance sheet, with a Tier 1 leverage ratio of 5.9%, a CET1 ratio at 11%, a liquidity coverage ratio of 111%, and a net stable funding ratio of 130%. They have an incredibly safe and stable foundation.
And because of this financial fortress, they aren't just sitting on their cash. They actually returned a massive $1.5 billion directly back to their common shareholders this quarter alone. That breaks down to $371 million in dividends and a staggering $1.1 billion in share repurchases. Not too bad, right?
Which brings us to Section 5, Updated 2026 Financial Outlook. So what does this all mean for the rest of 2026? Well, driven by this undeniable momentum, BNY completely rewrote their expectations. They drastically upgraded their 2026 total revenue outlook from a modest 3 to 4% right up to a striking 10 to 11%. To literally triple your growth outlook mid-year, that is almost unheard of for a company of this maturity. Now, naturally, with fundamentally increased revenue comes a slight upward revision in expenses, but it's for a very good reason, fueling further growth. They've shifted their expense target slightly from roughly 5% to the 6 to 7% range. This ensures they can continue safely funding those key tech and AI investments without sacrificing their operating leverage. As their mid-year update plainly states, strong execution continues to accelerate growth and strengthen our competitive position. It's abundantly clear that their strategic discipline, operating as one BNY, is yielding unprecedented scale across the entirety of their platforms. They are systematically proving that a legacy institution, a foundational pillar of the banking system, can actually operate with the agility, efficiency, and growth rate of a modern tech-driven firm. So, I'm going to leave you with this to ponder. With record revenues logged across every segment, an upgraded double-digit outlook, and actual AI integration accelerating at this pace, what ceiling is left for legacy financial institutions to shatter? Thanks for joining me on this explainer. I hope this helped clear the picture on a truly historic quarter.